Pretty nice day in Astoria. It's overcast, but it's fairly cool. It's not super hot, very chill. Everybody's in a good mood. So I kind of like it. Astoria is a beautiful place to be. Going to talk about how it is that the market's perception of what it is that's coming to the future is actually stimulating the economy. Now, most people won't see it this way because they're going to see like the Dow falling and all the rest of the markets, tumbling, in a pretty dramatic fashion. But when you really think about what has taken place is that people are in fear. And so they start moving from a risky asset into a more secure asset or a safe haven asset. And a lot of times we are going to find that safe haven asset being US Treasuries. Now, whether or not you agree or disagree with the idea of a US Treasury being a safe asset, I mean, that's kind of questionable. But the markets see it that way. And typically, when you find fear and uncertainty taking place within things like the stock market or just the future in general, a lot of people want to get out of their assets that are risky and move into something that is going to be closer to cash. And that's usually what you find going on with the US Treasury. I mean, it's the most liquid, deepest market in the entire world. And if you ever wanted to sell a Treasury, generally there's going to be somebody there to buy it. Now, the Federal Reserve in the Treasury had done something a couple of months ago that I thought was pretty interesting considering what it is that we are facing today. Now, they knew months ago, like a year or more ago, that there would be a position that they would have to take in which that they would be buying back their own bonds. And now I'm talking about the Treasury itself, not necessarily the Federal Reserve, but the Treasury, and that they knew that there was going to be times in which that people were going to be in a very uncertain position, and that idea of a liquid bond market would have to be there. Like people taking on risk or worried about risk, and they see like uncertainty within the bond market, meaning that if they had a bond and they wanted to sell it, if there wasn't a buyer, that would freak the bond market out, right? They would be very like cautious of that situation. However, with the Treasury saying, hey, we're going to be here to buy back these bonds, the market participants, the willing participants, will then come to the table and say, hey, man, we have no worries, because if there was ever a moment in which that we wanted to sell these bonds, the Treasury says that they'll be there. And during the same time that the Treasury was making this announcement a couple of months ago, the Federal Reserve almost at the exact same time had also made an announcement of adjusting their balance sheet, meaning that they were allowing a certain amount of treasuries to roll off the balance sheet. They have reduced that roll off, meaning that they're not letting as many, meaning that they are now more of a buyer. They're not a buyer, they're a seller, or not necessarily a seller, but allowing these treasuries to mature and fall off the balance sheet. They're not allowing as much to come off the balance sheet. So they're taking some of that proceeds and rolling it back over into treasuries, but they are reducing the amount that they are holding. So yes, they are still in quantitative tightening, but not nearly as much. So again, this is a change that the Federal Reserve did a couple of months ago, but that's it. Those are the only changes that have really taken place. Now, yes, there is the Plunge Protection Team and all these other people who can, step in and deal with market slides like we are seeing. They have circuit breakers and, things to prevent any more losses to come to the markets during questionable times like this. And I'm not trying to say that those things aren't happening, but ultimately what we see taking place within the interest rates is that we see a lowering of rates. The 10-year Treasury is coming down, even if it's out of fear and uncertainty, right? It's still taking place. And that you see these 10-year Treasury coming down, you know that is going to start moving into the rest of the interest rates that the people are experiencing out there when it comes to the loans that they take. Now, regardless if they take a loan with the low interest rate, that's going to be another question out there. But the fact is that it is happening. And you're seeing that move into the mortgage market. So again, when we think about this, like just take a distance, right? Look at it from a distance and kind of, eliminate the idea of why it's occurring for just a moment, right? And just look at what is occurring, and that is a lowering of interest rates. not only in the US 10-year Treasury, which is the main indicator of where most interest rates are going to go, but we're starting to see it happening within the mortgage market. And I left a link down in the description to a YouTube news, article talking about this very thing and how the conditions is becoming more for a buyer. We're seeing home prices coming down in some areas, although they are still quite elevated considering most of what we have experienced over the last 2 years. A lot of elevated home prices still exist within the markets, but the interest rates are coming down some. And again, this is all off of market perception. Nothing has changed, right? Except for the belief that the Federal Reserve will be lowering interest rates in September. In fact, they are going to probably throw one hell of a hissy fit if it doesn't happen. However, if this thing continues with the belief that the interest rates are going to be going lower into the future and the uncertainty about like a recession, because you really have to think about it, the moment that the Federal Reserve goes to lower rates, it almost always indicates or triggers a recession. Now, whether that's the trigger or the preliminary to a recession, go back and look at all the Fed charts or the Federal Reserve fund rate charts throughout history, and anytime that comes down, it goes into a recession. So people who are really anticipating, hoping, and begging for there to be a rate cut coming into the future, you're almost hoping and begging and believing it into the future, a recession. Because that's usually what ends up happening. Now, think about this. The Federal Reserve uses credible threats. That means their words, the forward guidance, the signaling, the belief of what it is that is coming is more of a monetary policy tool than the actual rate cuts are. Now, look at what's happening right now off of the belief, right? The credible threat theory is now running rampant through the economy. People are all but have locked it in a September rate cut, and they are acting accordingly. Now, this is going to, over time, believe it or not, actually have a stimulating effect if you see it within the mortgage market right now. Just look at these mortgage rates coming down. It doesn't mean that people have taken out loans yet. It means they could going into the future with a better rate. And it's starting to appear right now. So give it time, and if this continues, right, this belief that there's going to be a September rate cut, and I'm not trying to say there isn't. What I'm trying to say is the belief of it is more impactful to the economy right now, to the people, than the actual rate cut, because look at what it is doing. It's bringing the mortgage rates down. It has people in fear of the stock market. They're moving into the bond market, and you're going to start to see that the availability of a cheaper loan is going to start presenting itself. Now, if cheaper loans, like what I mean by cheaper loans is less interest rate, if that starts to present itself into the markets, then more people are going to be able to have the ability to make the payments on the loans. Now, I'm not saying that everybody's going to. What I'm saying is that when those interest rates come down, it exposes more demand. That makes it very difficult for prices to come down. All right? And now we think about it again, that the Federal Reserve has an issue with elevated inflation. Yes, it has come down, but has it come down enough for them to actually adjust rates? Well, what is the number one cost when it comes to inflation? It's your house, it's your rent, it's your payment. That's what's the number one cost, right, for driving inflation. And if this is elevated, or if you start creating more buyer demand, then how is it that housing prices are going to come down? How is it that housing rent is going to come down? It's not. It's going to remain elevated if the interest rates come down. So again, this doesn't make sense for the Federal Reserve to lower rates going into September if we have an elevated inflation, especially when it comes to assets like homes. This is again, like, the cost of living is going to be elevated if the house price is elevated. And how is it that house price is going to come down if you don't bring the interest rates, or if you keep the interest rates elevated? That's the only way to get the house prices down, right? Is to fight inflation through that. If you bring the interest rates down, then how is it that the house prices are going to come down? I mean, wishful thinking. It's like even now, you think about it, the elevated prices stopped the home prices from going up as much. It didn't necessarily stop the home prices from going up, but it stopped them from going up as much. In some areas, they plateaued, and in a few areas, you actually seen them come down. But the moment that you reverse course on those interest rates, you're not going to see home prices coming down. That doesn't make sense. Okay. All right, let's move on here. What you guys talking about? We got 269 people watching with 55 likes. Go hit that like button. We'll get more people to join in on this discussion. The YouTube algorithm loves it when you hit the like button and comment. My man's not lying. All right, markets tanking is good for inflation. But now I have to question that. Now, is it? I mean, markets tanking, this is like not necessarily, to me, like what I'm seeing or witnessing what's going on in the markets is literally fear and anxiety, right? People having no clue of what it is that's really taking place out there. Think about it. If we get the inflation to come down, right? If we get it to come down in a significant way, then yes, I would imagine that the Federal Reserve would have to reverse course on their Fed funds rate and start to lower rates to avoid the recession, to avoid, massive unemployment and bankruptcies and all that other stuff. Yes, I would imagine that to take place. But if the market perception is that there is going to be an interest rate cut and then they start acting accordingly, and that acting of believing that there is going to be rate cuts going into the future starts to create a scenario as if those rate cuts have occurred, and it starts to juice things like the home prices out there, then there's no way that the Federal Reserve can reverse course. They won't be able to. And that's what I find quite interesting about finding the evidence of it now occurring. It's a credible threat theory. We have to internalize it for what it is. Those interest rate adjustments don't work like they used to. But the markets don't know that. The belief of it and their actions has more of an impact on the economy than anything else. Regardless of the rate cuts, just the belief, the perceptions, their actions that they take. That has so much more power, and the narrative that they control has everything to do with it. Just go and look and see how many articles are out there, like pretty much demanding that the Federal Reserve act accordingly to what the markets are asking for, which is a rate cut in September. It's like, it's unreal. It's no other article really even discussing anything other than that. There are a few, but few and far between. The more you hear this, the more you believe it, the more you start acting as if it happened. And again, this is just we're witnessing it taking place. If those mortgage rates come down and continue, like we saw something very similar to this. Like, it's not exactly the same tune, but go and take a look at the U.S. Treasury, the 10-year Treasury, and go and look at mortgage rates at the end of last year, right? At the end of 2023. See, they didn't do anything. They didn't lower rates. They didn't adjust monetary policy or anything else. But yet we saw mortgage rates in the U.S. 10-year Treasury drop significantly at the end of last year. Very much like what we are witnessing today, based off of the damn dot plot that had predicted, 20 cuts this year or whatever it was, even a dozen or something. I can't remember exactly what the dot plot was predicting, but everybody was convinced by it. The Fed had made their pivot. They have turned around. The Powell has, decided to cut rates. None of that happened, right? I mean, that was all like, think back. I know it's hard because, we only kind of, we have a very short attention span. I know I'm one of them, right? I mean, that's why one of the reasons why I even started a YouTube channel is to record some of my thoughts, because I have a short attention span. But just remember what was being said after the dot plot, right? At the end of last year, it was so much confirmation of interest rates coming down that people were actually taking on the idea that they could buy a house and refinance it into the future. It's like real estate agents were using that as a sales tactic. Think about it. 7 months later, didn't happen. Now it's starting to happen again. We're starting to see mortgage rates come down, but it's based off of the credible threat theory. Again, when you think about what it is that the Federal Reserve was saying about what September rate cuts would be. Everybody is just like convinced of it. It's so like, I don't know, it's so obvious to me. All right. Uneducated economist, I've been trying to prove to you that rates that affect us are going to adjust on their own. You keep telling us the Fed has some power over things. The Fed's hands are tied. You're wrong, Joe. Sorry, Joe. You're absolutely incorrect about that. Go ahead and run with your theory. That's fine, right? But I was calling this stuff out over a year ago that this is exactly how it was going to be going down. That the Federal Reserve was going to be like, oh, are we going to cut? Oh, no, I don't know if we're going to cut. Maybe we'll cut. I don't know. There's looking like we're going to cut. And if they put the narrative out there, it will start performing as if the rate cuts had already happened. We are witnessing it taking place now. You are denying it, but that's okay, right? Because most people, 99% of the people, will deny this, much like you are doing. Right? However, I predicted this. I said this is exactly how they are going to conduct themselves going into the future. And there was very little doubt in my mind. Right? They kept interest rates too low for too long. How many people heard that? Well, they kept interest rates extra low, extra long for an extended period of time to make up for the fact that they had failed to achieve a 2% inflation target over the previous 10 years. So by keeping interest rates extra low, extra long for an extended period of time and having the inflation expectation extremely elevated, then started to create the environment in which they would get their ammo back, which was the elevating of the Fed funds rate and the rising of the neutral interest rate. Now, if you don't want to incorporate that stuff into your theories, that's fine, right? But that's what the case is. That's the reality of it. I know this because this is what they keep referring to over and over and over again. It's starting before this, but with this speech, monetary policy strategies for a low neutral interest rate world, right? And the problem they needed to solve was the risk of inflation that was persistently too low rather than too high. Well, now they got inflation that is persistently high. That was the problem they needed to solve. They did it. They got it. Yay for Fed. Not that I'm agreeing with the Fed, but that's what they were going for. That was their goal. And everybody says, nope, they don't know what they're doing. I don't think so, right? They have planned this out for 20 years. They have set up over the course of the last 12 years the communication styles in which that they can now control the narrative of what it is that the market is seeing out there. They never had like communications like the dot plot. They never came out with, the interviews and governor speakings and stuff like that they do nowadays. None of that took place. The Federal Reserve was very quiet. In fact, they never even announced that they were going to make interest rate cuts. They would just come out one day and say, hey, boom, interest rate cuts. They thought that it was more impactful to shock the market with a rate cut than it was to let them know what was going on. The more they realized that if they communicated what it was that they planned on doing, they could get more out of their rate cuts. The more they communicated about it, the more power they got out of their rate cuts. The more they set up styles and communication networks and different ways of getting this narrative out there, they found that it was the most important part of their monetary policy, more important than the rate cuts themselves. Right? And here we see it. We're witnessing it in real time, plain as day. But no, like their hands are tied. They don't know what they're doing. It's not true. It's simply not true. All right, Javelin, thank you so much for that $5. What does this market downturn mean for gold and crypto, if anything? Okay, so if you notice, like you're going to start seeing when you have a risk situation like we are doing, if the Fed lowers rates, it's almost guaranteed that we are going into recession. Just look at the Fed funds rate, Fed funds charts going back through history. Anytime they lower the Fed funds rate, it's almost guaranteed you are going to see a recession after that. It's not guaranteed 100%, but it's generally speaking, that's what you're going to see. So now the market is very fearful of September because that's what's going to be the indication of, hey, man, you're going into recession, bad times. You're going to start losing all your money and all your assets. You better get out now. Gold, crypto, stocks, doesn't matter what it is. So you're going to get out and you're going to hold cash, but now you're a little still worried about inflation. So what do? You have no other choice but to put it into something that's going to have a return on your money, and that is the safe and liquid assets of U.S. Treasuries. So this is the reason why you're seeing the bond market rally like it is, and everything else out there is losing. Hey, Mike, what's happening? Good morning, bud. All right. Same thing. It's It's the risk of uncertainty and fear and not knowing what it is that you're going to find taking place within all the prices of all your items out there when the Fed is like committed to getting the job done, and everybody is now looking at the September rate cut thinking, okay, if that's the case, we're going to see inflation coming down dramatically. That's going to be recessionary forces that are now impacting the economy, and everybody's going to be like real like worried and securing and not spending money and, you know, just all that anxiety and uncertainty and fear, right? So what do? Like, I mean, I'm surprised that you don't actually see gold rallying more, but that's really because of what people are saying outside of the United States. Because even in outside of the United States, you have to understand these markets are crashing too, right? Like the whole globe is facing this right now. And when that starts to take place, there's really, where are the places you're going to go, right? You're going to go into Chinese or Russian currency or an Indian currency? Hell no, you're not going to buy any of those assets, right? You're going to be buying what I would assume would be the safe haven asset of U.S. Treasuries. This is very much in line with Brent Johnson's dollar milkshake theory, right? You give it time, like right now, it's surprising to see the dollar coming down. But again, like I think everybody is scared about everything out there. And now, when you think about like when it gets to a certain point in which that, okay, how much fear and uncertainty is now collapsing the system, you think, okay, where is it that I'm going to go? If you were going to find the safest place that you could be, and you have things collapsing, you don't even know if governments are going to maintain themselves, you don't know if corporations are going to make it, like there could be some major civil unrest taking place as people are losing their jobs and their livelihoods and retirements and all this other stuff because they didn't prepare themselves and didn't think about what that kind of environment would look like. When you get down into that situation, really, where is it that you can go with your money? I mean, are you going to even trust the United States at that point? Probably not. I mean, we do have cryptocurrencies, which does give us a little bit of, you know, exiting from that third party, but there's no other place like precious metals. It's just gold and silver. And so you give enough pressure into this economy, and I would imagine that you would start seeing gold and silver start to find that safe haven asset very much like the U.S. Treasury. But right now, most people do not look at gold and silver as the safe haven. They look at the U.S. Treasury. Okay? It's just the way the globe sees it. Civil unrest when the bank holiday comes, when the power goes out, you can't use crypto. Rate cuts cause oil to rise. I mean, you know, people were telling me that oil was going to go to $500 a barrel, and I would say I would be surprised if it actually went anything above its all-time high. Right? And this was when it was encroaching in on its all-time high. Because I said it was probably going to do the same thing that lumber does. See, once the oil gets up and it gets expensive, well, then next thing you know, the input cost, the traveling cost, all the stuff that for everything starts to become very expensive, and then all of a sudden you have a slowdown. Well, then the demand for oil falls, right? Very much like what we're seeing. You think about it, the three most vital commodities to the human existence right now: lumber, oil, and silver. These three vital commodities to the human existence are sitting at 50% or less of their all-time high. Right? Does that seem right to an inflationary environment? Or are things just so obscured that nobody really understands what is taking place out there when it comes to the price settings, the inflation, the money printer, right? Inventory levels, all this stuff. Three most vital commodities to the human existence sit at 50% of their all-time highs. I mean, sure, they're manipulated. Sure, there's all kinds of issues to it. Right? Facts are facts. And so understanding it from a different view, understanding it from an idea that the Fed needs, absolutely needs to raise the neutral interest rate. Understand what the neutral interest rate is. It is the rate that is neither accommodating nor restricting the economy. And for the last 25 years, it has moved ever closer to zero, to close to 0%. Meaning that when the Fed drops interest rates and hits the lower bound of zero, it doesn't stimulate the economy. Not like it once did. It's one of the reasons why we had to use, or the Fed used, and kept the economy going through quantitative easing 1, 2, 3, and 4. It's because traditional monetary policy of interest rate adjustments was over. And it's been over for a while, but nobody knows it, right? Everybody looks at the Fed and their interest rates as the key indication of what monetary policy is going to do going into the future. It's not it, right? It's the narrative. It's the jawboning, it's the forward guidance, it's the signaling. That is what's guiding it. You can witness it right now because nothing has changed. Nothing has changed from the Federal Reserve. They are conducting themselves the exact same way that they have been doing it for the last few weeks. And other than the balance sheet adjustment that they did back in June, they haven't done anything different for months. But the belief is definitely changing. Yeah. All right. Bro, you and Sarah need to refi and take some of that funny money out of that house before it's too late and the house finally does. Well, okay. Okay, what are you saying? Like before I'm underwater? Like are you believing that the house prices are going to be falling 30-40%? I mean, because that's probably what it would about take for me to go underwater on my house right now, considering what the 25. Here we go, 25%. Right? Even if it did, I would be at even. I'd be like where I would owe as much as the house is, right? I am not worried about it. Like what you're trying to do is put fear and anxiety and uncertainty in me, and I'm not worried about that. Like I have zero fear of anything going on out there. Like all my fear and anxiety and all that other stuff about what's going to happen with politics and New World Order and failed economies and all that other stuff, I don't think like that anymore, right? Failed economy? What does that look like? Your failed economy? I mean, the economy that you were expecting failed. I mean, whether or not it's the financial system, government system, going back to like commodities like gold and silver and using cryptocurrencies to do exchanges, like all that stuff. Yeah, let's do it, man. I don't care. One way or the other, it's going to happen. And so to put out there, you better do something or else, you better get your money out of the bank or whatever. Yeah. Yes, please explain yen trade carry and the reverse effect happening right now. Okay, so to understand the carry trade, if you can borrow yen at a really low interest rate and then go and lend it at a higher interest rate to somebody else, that's the carry trade. It's essentially like imagine like the yen has like a buying and selling window. The Treasury has a buying and selling window. It's literally carrying from one window to the next. That's what they call it, a carry trade. And so when you think about like this carry trade unwinding, meaning that if the yen begins to rise, if the yields do, or the yields on the US Treasuries come down, all of a sudden there's no more like real room for profit inside of that carry trade. Now you have to unwind that position, which means what, right? You end up starting to, like if you bought bonds or whatever, lent it to the United States, well, now you're going to be selling bonds. Or if you are taking that money and lent it out into something else, now you have to sell that to unwind the trade. So it's a huge kind of a complicated, aspect of it. But I really look at it and think, okay, how much can this really like overall impact the economy as far as like, is it going to trigger the recessionary issues? Well, I guess if it continues on in that fashion, you might find where more unwinding takes place, where more sell-off and more, repositioning. Yeah, all that stuff can be quite painful and, drive down and create like, bad economic times if that's the position that you have taken. So yeah, I could see where this is going to continue, or if it continues, it would continue to create the economic hardships that a lot of people are going to be facing as they try to get out of that position, right? But again, like how much or how impactful it's going to be over the long run, like will it trigger an actual economic downturn? I think it's probably going to be more of a painful experience that maybe for some people would be an economic downturn. But like as far as its position, I don't know. Like a lot of people had talked about that one coming for a while, and this is why I have a tendency to not get too nervous when somebody is like actually talking about, like, okay, take for example, you better get your money out of the bank before the bank failures start to happen. It occurred, right? The bank failures occurred. The people who were saying get your money out of the bank because there's going to be a bank failure occurring weren't lying. They were right, right? That's what we experienced over the last year. Silicon Valley Bank was like, like the main one that everybody was focused in on. So they were right about that. What they were wrong about is that everybody knew that it was coming and they did something about it, right? They had a backup plan. And so this is what ends up happening a lot of times when we see like these major events happening, much like the unwinding of the carry trade from the yen. It's not like the powers that be didn't see it coming too and know about it and act accordingly for it. Yeah, it was a bad time when the bank failures were taking place, but was it a systemic problem that took down the entire banking financial system like everybody who was saying get your money out of the bank was claiming? No, it didn't even come close to that, right? I mean, I guess it kind of came close to it, but it wasn't like they didn't have plans for it. They had plans. The Bank Term Funding Program. I mean, they launched it immediately. They were like, oh, there it is, time to fire it off, bang, and that's what they do. All right, north-south, $1.99. Would you live on 25 acres in Kansas Hills? I mean, I guess. I don't know. I mean, I like living here in Astoria. I like it here. Yeah, but it doesn't get any easier, Toaster. How much does it cost to build a new house compared to how much a new house cost? Well, that's a very good question, and I think that's really going to depend on the location that you're at. Now, when it comes to the lumber part of things, it's fairly inexpensive considering what we have had over the last couple of years. Now, is it cheap to build a house? No. You got permitting costs, labor costs, all the rest of the material like siding, doors, windows, all that kind of stuff. That's all still, quite elevated. And from what I understand, like places like here in Astoria, they're going to make the permitting cost even more. So I can't imagine that would make it cheaper to build a home if the permit cost goes up. Right? So how much does it cost comparatively? I would imagine it's still more expensive today to build a house than it was prior to the pandemic. Right? I mean, that's probably pretty safe to say. And so even like, the replacement cost of a house now, I mean, what is that? It's, probably quite elevated. And even considering how much lumber prices have come down. What time is it? Alrighty, guys, I'm going to have to call it quits here in about 5 minutes. Oh, yeah, when Republicans, my so-called party, votes to not extend child tax credit, I am glad I don't vote. FOMC emergency meeting. Yeah. Is it taking place? See, like, here's the thing. Once they fire it off, once they fire off the direction of an interest rate cut, and I'm not trying to say that they won't do it, right? That's the important part of like my theories and trying to discuss out here, because people say, you say they won't cut. I don't say that, right? I don't say that they won't cut. What I'm saying is that the belief of the cut has more impact, and that's what I'm trying to explain to people and proving here through my channel. Is that the more that they communicate about it, the more impact on the economy it has, and we are witnessing that today, And so, and I'm seriously doubting that they're going to move it. Only because once they have cut rates, that's it. They will not be able to adjust them the other way without losing the credible threats, that the ability to have the forward guidance and job owning. Nobody will really understand or believe what it is that they are trying to say out there, because then they're going to really have no trust for the Fed. Because if they drop them and then raise them and then drop them and then raise, that's not going to work. They will have no more credible threat. They will not have the ability to adjust markets' perceptions through the narrative. If they do that, it just will fail. And that's the main policy tool. So that's precious to them, right? Interest rate cuts, nah, that's not so precious. They don't care about the interest rates, right? They care about the neutral interest rate and making sure that goes up. But as far as cutting rates, no. The belief of it, that's what they care about. You can't believe what the Fed say. You have to see what they do. Incorrect. You can't trust what they say on the mainstream media. What you can trust is what they are communicating to the other central bankers through these speeches. Now, if you go and you join the channel, you will have access to the member-only videos in which that we have broken down dozens of these speeches for you to internalize so that you can have an understanding of the monetary policy, credible threat theory, very much like a lot of people here on this channel have done. Once you have understood that, you are going to see how it is that the communications to the mainstream media is guiding the markets. But then when you go and you read through these speeches, when you listen to the member-only videos that we have done, you're going to hear and understand how it is that they communicate to the other central bankers in a different way. Think about the 2% target. A 2% target doesn't exist on the monetary policy. We here on this channel know this for a fact, because of all the things that we have broken down. Look at flexible average inflation targeting. That is the monetary policy of the Federal Reserve, where they seek to achieve an inflation rate of 2% over the long run, over time. That means that they do not have to have a monetary policy that is targeting 2%, but then at times, appropriate monetary policy seeks to achieve inflation that is moderately above 2% to make up from the shortfalls of the 2% target that they fail to achieve. Very important to understand this. Most people have no clue about that. 99.9% of the economists and people that you hear communicating about what it is that the Federal Reserve is doing has no clue about flexible average inflation targeting and believe that the Fed is going for a 2%. It is wrong. That's one of the reasons why they think that the Federal Reserve doesn't know what they are doing. All right? See, and the Fed doesn't communicate it to you. They don't want you to know that they're going for a flexible average inflation targeting. They want you to be locked in at a 2% inflation target over the long run, which means that a 2% inflation anchoring is their goal. But that's over the long run. So if there is a failure to achieve 2% inflation for a decade or more, they will have to have, according to their monetary policy, inflation that is moderately above 2% to make up for that. This is what we are experiencing. Nobody wants to discuss it like this on Bloomberg or Wall Street Journal or CNBC. Nobody wants to communicate it like that, but this is what I am saying to you, the reality of the monetary policy. I don't care what anybody else says. I will debate anybody on this. I don't care who they are, right? I've read through hundreds of speeches in order to be able to communicate this to you, right? It's like, I'm not like just making this stuff up. I have evidence of it. I have linked all the speeches. I've highlighted them for you. I reiterated it constantly, right? And proven it time and time again, showing it in real time how this credible threat is working. And it's evidence of it today. You can see it right now, clear as day. But if you're not aware of the credible threat, you're going to totally miss it. You're going to totally miss it and come up with excuses or blame or anything else out there, but not seeing it for what the reality of it is. Alrighty guys, I'm done. I got to go. You've been a beautiful audience today. We got 500 people watching with 142 likes. Please go hit that like button. By hitting that like button, the YouTube algorithm is going to grab this video and spread it around for more people to join in. This is an important topic. This is incredibly important to internalize, to understand for ourselves, because there's nobody else out there who's going to explain it, right? I mean, it's scary to think that they have such control over the narrative that people really just don't see what it is that they're truly doing. But to know that they just don't communicate it to anybody other than the other central bankers. Like, we all have access to these speeches. They're not hidden. They're dull, they're boring, they're complicated, they're hard to get through. That's work, right? That's what's called work. That's what I do, right? That's what I try to break down for us. The member-only videos is a discussion that breaks these things down. We are all going through it together to try and figure it out, all right? Okay, Uneducated Economist, you guys let me know. Thank you guys for being here.